of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. IRDAI in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Welcome to the Business Standard Banking Show. My name is Bhaskar Datta. In this week's episode, we discuss the significant developments of the week, including an additional meeting announced by the RBI's Monetary Policy Committee. We have an interview lined up with R Subramaniakumar, Managing Director and CEO of RBL Bank. In our Banking for You segment, experts decode insurance regulator IRDAI's one-stop shop for all insurance needs, Bima Sugam. Our banking expert Tomal Bandopadhyay discusses the need for banks to raise deposit rates while protecting interest margins. At the end of the episode, we shall discuss the results of our last poll and share the questions for this week. So stay tuned. With CPI inflation in September printing at 7.4%, the price gauge has been outside the MPC's mandated 2 to 6% range for 3 successive quarters. This means that the rate-setting panel is deemed to have failed to achieve its inflation target. According to the RBI Act, a letter must now be written to the government outlining reasons for failure, proposing remedial steps, and providing a timeline for inflation to be brought back to target. The MPC's additional meeting today is likely being held to flesh out the details of what the RBI will say to the government. The RBI has indicated that it may take around 2 years for inflation to head back towards the 4% target. Incidentally, CPI inflation has been above 4% for 36 months. While the surge in global commodity prices following the Ukraine war posed a huge upside risk to India's inflation, core inflation too was well above 6%. Core inflation strips away the volatile components of food and fuel. So far in 2022, the MPC has hiked interest rates by 190 basis points. For over 3 years, the RBI maintained liquidity in the banking system at a large surplus, as it sought to boost economic growth, especially at the height of the COVID-19 crisis. Going by the RBI's latest data on liquidity management, the days of easy money for banks are over. In September, banking system liquidity briefly slipped into a deficit for the first time in 3 years. The liquidity conditions have tightened much more in October, with the central bank infusing an average of Rs 58,200 crore into the banking system for the last 10 days of the month. The tighter liquidity comes amid booming bank credit growth, increased demand for cash during the festive season, and the RBI's dollar sales in the foreign exchange market. Banks are now rushing to raise deposit rates to garner funds amid the shrinking pool of liquidity. Raising deposits from the market has also become a more expensive affair, as sparser funds have translated into a surge in money market rates. Talk about the pressure to increase deposit rates, and the future trajectory of banks' interest margins springs to mind. Results of the majority of private sector banks in the second quarter show a stellar rise in interest margins and profits, as banks were quick to pass on the RBI's rate hikes to those seeking loans. Banks were much slower to transmit the policy rate hikes to deposit rates, thereby pushing up interest margins. With the economy recovering from the scars of the pandemic, the proportion of bad loans also fell. While providing a guidance of 15 to 20% credit growth going ahead, RBL Bank is looking to explore avenues other than its traditional strengths of credit cards and microfinance. These avenues include secured retail credit, vehicle loans, gold loans, and a major thrust on housing loans. I spoke to RBL Bank's MD CEO, R Subramaniakumar, to discuss how the private lender plans to stay competitive on deposits. Subramaniakumar also spoke about how the bank is shifting towards granular deposit growth as a conscious strategy, instead of depending on corporate bulk deposits, which come with their share of volatility. RBL Bank on Saturday reported an over six-fold rise in net profit for the second quarter of the current year at Rs 201.55 crore, as provisions came down sharply and the net interest income showed firm growth. we have the bank's MD CEO, Mr. R Subramaniakumar, to discuss the latest results and the way forward. Welcome to the show, Mr. Subramaniakumar.
Thank you. Thank you very much, Bhaskar. Thanks a lot.
You have provided a guidance of 15% loan growth in the current year and 20% for the next. Which are the bank's focus areas when it comes to the credit growth?
Fine. See, if you look at that, traditionally the bank has been growing in two niche areas. That's in respect to the credit card and microfinance. The microfinance, the growth has commenced from the late June of this year. And this quarter, we did around 1,800 crores. And we have a potential to grow more than 2,000 crores in that space, which will continue to grow in that space. The second, traditionally, we are the fifth or sixth largest credit card issuer. And as the spend is concerned, again, we are somewhere in fifth and sixth of amongst all the credit card issuers in the country. And we continue to maintain our leadership position in that. And we will continue to grow around 17% there. But if you look at both of them, it doesn't give me an overall book growth of around 15 to 20%. So we need to look at alternatives available to us or alternatives possible by us. Some of the alternatives which we have identified as a bank is that secured retail credit. So we are going to expand our market in respect of the two-wheeler, used car four-wheeler, and the gold loan during this quarter. And during the next quarter, we'll have a secured LAP loan. And we are going to go for the housing loan in a big way, which is already there in our kitty. And we are going to expand our education loan and personal loan. There are some of the other products which we wanted to roll up during the next quarter. Today, if other than the microfinance, I think we have a wholesale book which is also growing, which is at the rate of, if you look at it, last quarter it grew by 22%, and this quarter it grew by 20%, whereas the other retail grew by around 6%. So we are going to moderate there in order to get a better return. So the return yield, if you look at it, traditionally the corporate doesn't give me much of the yield. The yield is averaging somewhere around 7 to 8% in the range. So that is not going to add up to my revenue, and that is not going to add up to my bottom line. So in order to increase it, we are having a shift within the wholesale banking. That is from the traditional wholesale banking where we may not be able to take a greater exposure. We are moving towards the commercial bank, where the commercial bank, what we propose to do is our rate yield is moved to the closer to 10%, 9 to 9.5%, better than the 7.5%. So another thing is the risk diversification is also another thing we are looking at that. There we will be concentrating on the mid segment and medium industries. These things will also trigger and fire our growth in the credit. So this quarter we clocked around 12% YoY growth, and sequentially we grew by around 6%, and we'll continue to maintain that tempo, and we will be reaching the 15% at the exit of this year, maybe plus slightly more. And next year onwards, we are comfortably we'll be able to do 20% plus growth.
You mentioned that the bank basically plans to fund the loan growth with the granular growth in deposits.
Correct.
But the deposit growth was at 5% in July, Sep. It was lagging far behind the advances. So what is RBL Bank's strategy to mobilize funds? And because right now it's a highly competitive environment when it comes to mobilizing funds.
Absolutely right. See, if you look at it, I want to divide this part into two. Today, I'm not looking at the growth in the deposit, the overall deposit, as well as the CASA deposit beyond a point with a simple reason. We have a CD ratio of somewhere around 72 to 76% range. The second, if you look at it, our LCR is 156%, and we plan to close our LCR somewhere 120%. So we are left with a surplus liquidity of 6,000 to 7,000 crore, which we are deploying today in our GSEC and things, which are giving me an average return of 2 to 4%. That will be deployed effectively during this year. And when we have an ability to deploy them and earn money out of it, we don't look at that CASA growth immediately. But the strategy which we have already started is that instead of depending on the bulk deposit, which comes from the corporate and it has its own volatility, so we are moving away from the bulk and coming into the granular as a strategy. The granular level, what we mean is that we will be increasing the number of accounts. If you look at the number of accounts which has been done during this quarter is double of what has been done in the corresponding quarter of the last year. So this demonstrates the ability of the bank to increase their baseline number of the branches. And if you look at it, one of the specific product or 2-3 specific products of the bank is a totally relationship based. That's one is Insignia. The second is a Signature, and we have Prime and others are there. I'm focusing on these two. These are all personally related to the relationship manager. This bank has achieved its specific position amongst all the peers on two fronts. One, it is giving an adequately a decent return, and the differentiated rate of interest is higher than others. That will put us one step ahead of the rest of the competitors. The second is our relationship strength is pretty strong, so that they will be able to leverage. So we are going to position the products which I explained just now, all the retail asset product at the branch, empower the branch manager to handle them. So that will also provide me another avenue for the granular deposit growth. The third is we are sitting on a huge pile of customer data which we have never leveraged for cross-sells and upsell. For example, we have a 4.6 million customer under credit card. This credit card has never been taken beyond the credit card given only, which we wanted to drive it for the liability product. We have around 2.6 million microfinance where the BCs, 8,000 BCs are on the field. They have never been ripped up for the purpose of getting the liability franchising. So these people will also trigger for getting the liability products, which will increase my granular deposit. The third is that we have a payment, 50 lakhs plus customer are using our payment platform for the purpose of doing any of the platform. We have a strong partnership relationship. So this will enable us to reap that and convert even a minuscule part of it, let us say even 10% if I'm able to rope in, they will be able to get a substantial customer acquiring strategy. These things will happen. Once they are acquired, the engagement will continue through our relationship manager. We will be able to scale up our deposit average deposit which is residing in those accounts.
So what is your guidance for net interest margins in the current environment? Because banks are facing a lot of pressure to raise deposit rates, as we said. Would you be able to maintain the 4.55% NIM that you are currently at?
With the new products, which is going to give me a higher yield than the average yield which I'm getting it, I'll be able to maintain is 4.5%. Then whatever that extra leverage which I get in interest income in the form of additional one, maybe marginally it will get impacted with my interest expenses because we are in a position we can't afford to give a rate of interest much lesser than others. So my 5.1% of the cost of funds may slightly move up to 5.3. Maybe in a quarter it may move by 25 bips to 30 bips. So which we will be able to compensate by giving our credit growth. So we will be able to maintain our NIM in the same range with this particular strategy.
That's it from our side. Thank you very much for your time, Mr. Subramaniakumar.
Thank you, Bhaskar. Thanks a lot. Bye-bye.
A major development is the IRDAI's Bima Sugam platform, a one-stop shop for all insurance needs. The regulator mooted the idea earlier this month, and the online platform is expected to go live on January 1, 2023. Bima Sugam will house all insurance companies and their products. It will be an online marketplace permitting insurers to sell their products, manage claims, and service their existing accounts.
The insurance regulator, IRDAI, has devised a one-stop shop for all insurance needs called Bima Sugam. Bima Sugam will house all insurance companies and their products. It will be an online marketplace allowing insurers to sell their products on the platform, settle claims, and service their customers. The regulator mooted the idea earlier this month, and the online platform is expected to go live on January 1, 2023. It will be a one-stop destination for all the insurance needs of a customer. They can buy insurance policies, port their insurer and agent, and settle their claims. All these facilities will be provided to policyholders with e-insurance accounts. IRDAI Chairman Debashish Panda believes the launch of Bima Sugam will be the UPI moment for the insurance industry. Bima Sugam will be a one-stop shop for buying and selling insurance, for policy servicing, and also for claim settlement. Insurance companies can onboard the platform. It's going to be plug and play with API interface, Panda said in an interview. According to Panda, Bima Sugam will be like an insurance shopping mall. When a customer enters the portal and types their Aadhaar number, data will auto-populate and KYC will be completed through Aadhaar. The regulator has asked several insurance companies, both life and general, to become shareholders in the platform by investing some amount of money. This platform will potentially reduce the premiums paid to the intermediaries and make insurance products affordable for a large section of the population. Brokers, web aggregators, banks, and insurance agents will act as facilitators on this platform to sell insurance policies. By providing easy accessibility to insurance products and services, Bima Sugam may help make them more affordable and revolutionize the insurance industry in the country, just like UPI revolutionized digital payments. From the insurer's perspective, it will allow them to reach more customers, and the acquisition cost will also come down, while from a customer's perspective, it will allow them to access a wide variety of products and flexibility in purchasing policies. Experts believe this platform would lead to ease of doing business for insurance companies as well as intermediaries. An insurance company has to do individual integrations with hundreds and thousands of intermediaries that lead to complex operations, which will get simplified with the implementation of Bima Sugam.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Our consulting editor, Tomal Bandopadhyay, who weighed in on the intensifying battle for deposits among banks, pointing out the linkages between the credit-deposit mix, liquidity conditions, and the government's borrowing program. He also discussed the modalities of how the MPC may respond to the government on its inflation target failure, and the expected path that the RBI may adopt at a time when the growth recovery is nascent and inflation is high.
Hi, Mr. Bandopadhyay. Thank you for being on the show.
Thanks, Bhaskar.
This week's Bankers Trust column has given us a sense of the need for banks to dexterously manage the liability side. It's true, of course, that the days of huge amounts of surplus liquidity are now over. Let's delve a little deeper into this. You have spoken about the need for banks to raise deposit rates, and we're seeing that at present that most banks have very healthy interest margins. But going ahead, would that change as fund mobilization becomes more competitive?
Actually, banking is more about how you manage liability than deposits. Aditya Puri is one person who continuously said that. And I have heard Mr. Uday Kotak also saying this. So your approach could be like, I pay high to the higher interest rate, relative higher interest rate to the depositors. And then I also charge higher interest to the creditors. But in the process, what happened? A bank ends up compromising the quality of assets. So the trick is how you keep your cost low, and at the same time, don't raise your interest rate for the creditors too high. So don't compromise the quality of credit. And at the same time, you keep a healthy NIM, that the so-called net interest margin. So banks have the advantage. Now, they don't have to, like, credit cost goes instantly for a borrower. Every month they are changing. But deposit cost for the bank goes with a lag effect. And for you and me, the depositors also. So it's a fine balancing act, and the banks will be facing this, have already started facing this. How to keep the margin intact.
You made a very pertinent point in your article, that is, if banks were to bring down their excess SLR holdings, then the government's cost of borrowing would go up. And we've been seeing, record high government borrowing programs over the past year or so. So how can banks deftly oil the liability machine, as you have put it?
You go to the market and raise CPs and CDs, which many of the banks are doing. You go for bulk deposits, which are being auctioned by healthy corporates, and you raise your retail deposit rates, term deposits, etc. So it's again, let me repeat, it's a fine balancing act, and this is the kind of situation where actually the men get separated from boys.
That brings me to one of the most interesting points in your article. You wrote about banks' obsession for growing balance sheets at the cost of their profit margins. And you just mentioned this point about some bulk deposits being auctioned by healthy corporates. Now we'll see that rates are going to go up further from here, and we will see that liquidity is going to dry up even further. So how would this affect bank profitability?
So this obsession for balance sheet is typical of public sector banks, not private banks. I may sound very uncharitable, but that's a fact. And post AQR, asset quality review, and the big bang expose of their bad assets, it actually was tamed. So the banks learned their lessons, and that's why the credit growth was pretty slow. If you see till last year, it was very slow credit growth. And of course, the external factors like COVID also impacted. But banks were very circumspect. Banks were using their discretion. But now we are seeing that credit growth is a decade high. So we are seeing that particularly, I would not name the banks, but some of the banks are giving money, particularly to state undertakings, etc., which they don't deserve the money.
We've seen that a recent report by State Bank of India has pointed out that about 55% of rate hikes are passed on to deposits. And it was referring to the existing mix of banks in terms of their CASA. So what would be your view on this?
For instance, State Bank of India is probably offering deposit rates, if I'm not mistaken, 2.75% on savings bank. Now, it has recently raised the term deposit rates by as much as 80 basis points. Mm-hmm. Now, would it continue to offer 2.75 or 85, whatever it is? I would like to believe, no, it needs to go up. And many of the banks are offering less than 3.5%, around 3% savings bank rate. So I'm not getting into the issue of you are depriving the savings community, etc. But this is untenable. It has to go up.
We're seeing that for the first time since its formation in 2016, the MPC has failed to deliver on the inflation mandate. So what can we expect from the additional meeting of the MPC? And should the statement to the government be in the public domain?
Under the Act, if the Reserve Bank of India fails to contain inflation with the flexible inflation targeting, that is 4 percentage point, with a band of 2% on either side, which means 6% on the higher level, for 3 successive quarters, that's 9 months, it needs to inform the government sort of explanation why it has failed, right? And this has happened. As we speak, 9 months have passed. And then when the current number will come for the last month also, you will see it is gone. There's a timing of the thing is very interesting. Of the meeting is 3rd November, just the day after the FOMC meeting ends. So I would like to believe, I'm no insider, but that will give the Reserve Bank of India also handle to take it forward, a sort of outlook on the interest rates and of course outlook on inflation. And second part is this, whether should it be public? Yes, of course it should be public. But RBI governor, the last press conference, post-policy press conference, had said, no, it's a confidential interaction between the RBI and government, and probably it's up to the government to make it public or not.
That's it from our side. Thank you very much for coming on to the Banking Show, Mr. Bandyopadhyay. It's always a pleasure speaking to you.
Thanks, Bhaskar.
Last week, we asked whether public sector banks need to be privatized. It was a close call, with 50.5% saying yes and the rest saying no. The government, which has long said that it aims to reduce its presence in running businesses, is committed to privatizing state-owned firms and implementing banking reforms. This week, we want your take on the issue of how the RBI plans to tackle high inflation. The governor recently said that the contents of the RBI's letter to the government on inflation failure are privileged, and that the central bank would not make the same public. But do you feel that the RBI's statement to the government on steps to control inflation should be made public? You can respond on Twitter, LinkedIn, Telegram, Instagram, and our website. Do let us know what you think. We shall be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.